seeing. So it is very important that we should always make a point that we learn, we share knowledge, okay? As we always say, is the intention of these trainings is just to remind ourselves, to do a recap, to try to put right possibly what has been giving us confusions in one or two areas, and just to help us increase our confidence in whatever we're doing with regards to trading. So it's about increasing confidence. It's about increasing confidence, and it's about seeing how best we can improve in areas possible that has been giving us challenges. Okay, so it's not something new always. It's always the same, something that some actually already know, but because you want something possibly to be adding, some flavor should be added on. That's why then we make it a point that we always repeat the same thing oftentimes. Okay. So in the course of the week, right from Tuesday to yesterday, there was a part that I was taking you through, one of the areas that is very vital in technical analysis, an area that can help you improve your trading if you understand them, and then you try to practice them often, or you try to make it a point that is my network okay? Is my audio okay? And is the network fine? Isn't it cutting? Yes, so something here. Is the network okay? Let me trust the network is okay. All right. On and off. All right. Please notify me in case it's cutting or breaking, so that I can always make sure that we're on the same page. Okay. Okay. Yeah. So just like I was saying, we looked at the chart. I mean the candlestick pattern, not the chart pattern, but the candlestick pattern, which we did summarize from the onset that it's a candlestick formation. These are candlesticks whose formation on the chart signifies traders' intention with regards to market price movement. And we said that this candlestick formation helps us to understand this trader's intention, which is either to push the price to the upside or to push the price to the downside, or literally an indecision on the trader's side to push the market price on either direction. So when we understand and learn about this candlestick, we are able to derive those information. All right. I also did say that this candlestick patterns oftentimes forms around the areas of price reaction on the chart. Hmm? Hmm? What do you Q? Okay. You gotta bear with me. Multiply with them. Yeah. All right. So it was said that these candlestick patterns tend to form around an area of price reaction. And we did say about price reaction areas are literally what you refer to as a support and resistance areas or zones or line, as most of you know. So the candlestick will never form in any other part of the pattern will never form at any other part other than those price reaction zones. Okay. Now, so the most important thing here is before we actually decide on making an entry decision, we need to pay attention to the trader's intention around that area of price reaction as the price approaches it. Because as we all know, as schools of traders, we have different groups of traders. We have those trading in the futures and those trading in the sports market. For a sports market trader, for them, the intention is to buy around a support zone or after a breakout above a particular resistance. All right. If you have those, if you have your price reaction zone there, with this one being a support and that one being a resistance, as a sports traders, oftentimes you're interested or you look out for trade entry opportunities around a support zone here, okay, after confirmation of a support, or when there is a confirmation of a breakout around there, right? That is for a sports trader. Meanwhile, on the other hand, for someone who's in the futures market, we'll look at either direction. One, we'll look out for entry decisions around support zone for purposes of making making entry onto long position or taking long position. And at the same time, also, they will look out for when a breakout happens, especially when the breakout confirmation happens around a resistance area, still for a long position. However, on the other side, they may also look out for a potential entry if the price is successfully rejected around the resistance zone. When there is a breakout confirmation, when there is a rejection confirmation around the resistance, a futures trader or someone trading in the futures market will look out for a short position opportunity, right? They'll want to take a short position, right? They'll want to short the market. So because of that, when we are making entry, depending on the market that you're trading in, you have to be keen on the kind of candlesticks forming around that price reaction zone. Now, oftentimes you must also understand that if you pay keen attention to these candlestick patterns, you will see that before a price actually reverses around the support, okay? Before it reverses for an uptrend, there should be certain formation around the support zone. Certain formation around the support zone. What we would call the bullish reversal signals. Bullish reversal signals. They ought to be formed around that support for you to ascertain that this level is actually successfully supporting the price. And by virtue of supporting, it literally means that there's a likelihood that it is going to reverse and begin rising up again. So, but before that happens, you need to be sure that at least what is happening around there with regards to traders' intention is candlestick formation that are intended for a bullish reversal. Okay? It is very important. Okay? So meaning the whole idea is if you learn how to draw support and resistance very well, that is one thing. Then two, before you make any entry around any particular support or resistance, you need to be sure that the candlestick formation around there is actually giving you the go ahead, is actually increasing your confidence with regards to what the orientation was to make entry. But if you see it is the opposite, then you can chill, you can relax. Okay, you have to relax. You always have to relax. And there are incidences where sometimes we get trapped by some of the candlestick formation around those price reaction zone. For example, if I may literally give you some of the few example, if the price, if you are looking out for example, to make entry after a breakout on a particular resistance zone, you know that a breakout to the upside intended for either a price breakout from a consolidation zone or intended for an uptrend is that it must be a bullish candlestick that should first open from below the resistance and then close above the resistance. Okay? Then any other that is going to be formed after the breakout should be a candlestick that should form from above the resistance. If it is a bearish candlestick, it has to close above without necessarily coming below the resistance. If it is a bullish candlestick, it has to open from there and then still close above. In case this happens, okay, this would be regarded as a true breakout. It will be regarded as a true breakout. I repeat this. Let me repeat it. A true breakout will be certain if a candlestick, if this is your resistance, this is your support. If a green candlestick opens from below, okay, if it opens from below, and then let me just use this. If it opens from below and closes above like that, then the next one that is going to open should either open there. If it is a bullish candlestick, it should also close above. That will be a confirmation of a breakout. Or alternatively, it can be a green candlestick opening and closing above. Then if the next one is probably a red candlestick that is going to be opening, let it open above and close above that resistance. Then you would make entry after the next candlestick. Let me just show you this. So if this is what happens, this two scenario happens, that will be true breakout. However, there are other incidences that happens where after the first one breaking out, the second one is probably going to be like a bearish candlestick, but a bearish candlestick whose low drops below the resistance. In such cases, you have to be more careful on this kind of candlestick, because you'll have to wait if you want to make entry after confirming the breakout. That means another candlestick has to open first. You need to confirm that the third candlestick going to open should open and close above. Then you can make entry from around there. Okay, you can make entry from around there. But if it is a bullish candlestick, after this one forming and the other one confirming, you make entry. That will be a sign of a true breakout. But if it is this case scenario where the green one opens below, closes above, then another one opens from above and the low dips a little bit below, you have to be skeptical. You have to be careful. You need to wait for the next candlestick, how it is going to fare. Okay, how it is going to fare. If it opens above and finally closes above, then you can now decide on making entry on the next candlestick open. Now, the kind of candlestick you need to avoid, which are most of the times traps, okay, into taking a long position or buying after the breakout, are candlesticks that behave like this. Avoid long candlesticks that breaks out. Like you may have that. Let me just take this. You have a candlestick that is very long, to open somewhere there. It is always very long. Most of the times, these ones here end up being a trap because the next candlestick will always be a bearish candlestick, which will open above and then finally close below. This would be sort of like a manipulation in the market. Other incidences of candlesticks that tend to be traps are candlesticks which are characterized by several bearish candlesticks, where we have they're of small sizes. You see them, small sizes, okay? You have, for example, small sizes, and then finally, this one shows very low volume. It shows very low volume, so you may as well tend to avoid them. It has to be normal candlesticks, okay? So when you want to make those entries, always be paying attention to some of those patterns that form. Now, if you're going to make, for example, any entry around a support here, support zone, make sure that the common candlestick going to be formed around there should either be a bullish, engulfing. It should be maybe a hammer. It should be maybe a morning star candlestick. All right. The common candlestick that brings about a bullish reversal. Those are the candlesticks that will actually help you make an informed decisions. But that occurs after you capturing and marking your support zone. And if you want to confirm later on, there's entry, you can add in a little indicator. So basically, with that regard, with that background, it is what we've been looking out for in the course, what we looked out or what we looked at during the 3 or 4 days of our learning the candlestick pattern. Okay, so today what I want to share with you, I want to give you an opportunity possibly to ask, to share with me or to ask questions with regards to specifically the area I looked at. If there is any question, if there is any supplement, if there is anything that probably you would want to add in or subtract or inquire about, this will be a chance for you to kindly do so. Okay, yeah, because basically with regards to candlestick pattern, those were the areas that I prepared for us, and I hope at least from there you can pick a lift and try to move further and execute or train or practice on them. So I'm going to give you a chance of asking questions any area that that we talked about in the course of this learning. And being a Friday, that's why I want to open up for that, because I wouldn't wish to close my sessions or the areas I handled this week without anybody asking a question, and then the person carries on with that doubt through to the next week. That would not be nice. So I give you a chance. You can ask me any question with regards to the areas we have looked at, and I will be glad to answer them if I can. Okay, so you can either drop them on the chat, or you can possibly raise up your hand and then you ask those questions. Okay. Yes, NVS, you have a hand up. Please kindly unmute. Unmute and ask your question, please.
Hello, I'm trying to find out which time frame is best for technical analysis.
Okay. All right. He's asking which time frame is best for technical analysis. Now, with regards to time frame, there is really no specific time frame which would be best for analysis. It depends on the kind of trader you are, if you're a trader who looks at or looks at wanting to take profit, small TPs consistently over a short period of time, short time frames like 15 minutes and possibly 30 minutes would be good for you. But if you're a trader who do not mind, you know, how long the trade may take, maybe hours or even the entire day, then you can always go for those long or high time frames like 4 hours, 1 hour. But for me, as regards to my own strategy, as I always say, I don't go for long time frames or big time frames. All my trading is always within 15 minutes, 1 hour. I only go for 1 hour to look out for, to have an insight or a forecast on how the price is most likely going to fare in the course of the day or in the course of the 1 hour. But I go so much down to the 15 minutes time frame to take those small TPs, okay, capture those earlier movements and taking entries and exits with small TPs, 1.5 at, you know, up to around 2% and exit, because the 15 minutes time frame in the build up on the 1 hour, possibly it could be a great move if it is, for example, bullish movement. And I trading in the sports market, I could easily make entry around there when I come across the support area where I'm having those candlestick formation intended to push the price up. And I'm going to give you a simple example. If I can go on my chart, go on my chart. See, let me just go to the chart. I'm trying to share with you something. Okay. I'm going to look out for take an example of this coin. Now you see, this is 15 minutes time frame, right? And this seems to be an uptrend. Seems to be an uptrend. That is 15 minutes. Let me first go to the 1 hour. The 1 hour, this is a movement after a long market price dump, right? After a long period of movement into the downside. And it is trying to retrace. This is a retracement happening, okay? This is a retracement. This is a pullback happening. After that long move, this is a retracement, okay? Now, in the look of this movement, you may, if I can use this, just let me try to drop this and I capture this movement. Now, in this movement, after the 100% movement, we have a retracement that is around the 38.2% fib level. And remember, the three key retracement fib levels are 38.2, 50, and 61.8. So you know that after the price movement being tracked by a 100%, the market price will have to retrace. That's the 1 hour, right? And if the price does not pull back to the 38.2 2% and then continues down, you'll be looking at the 50% fib level, or even the 61.8% fib level before the price can actually go down. If it is meant to continue down after this pullback, we expect a trend continuation, right, to the downside. However, at this point where the market price is, you may hardly look out for entry opportunities, okay, unless you intend to short the market, okay. But if you go, this is generally, from the look of things here, the price is already around a retracement zone, which is the 38.2. It is around there already. If you were to take up any entry decision, you would be possibly looking out for a short, right? You want to take a short position because you know possibly if you make entry around here, the price is most likely going to go down, but not forgetting the fact that you will have to know that there's also a likelihood that it can go to 50 or 61.8. Okay, so meaning those are areas you'll have to pay attention to with regards to setting your margin call drop on the upside, okay? But your intention is to go down because of the retracement. Now, to me, this cannot give me real confidence on making entry. So what I would rather prefer, I would rather want to come here and just literally track through this movement. Let me just delete this and track through this movement, okay? By looking at this, just a minute. I know that this is a mini uptrend movement, okay? It's a mini uptrend movement. I have that movement there. It was a mini movement, right? And if you look at this, the candlestick seems to be on my support. It's on my support zone, on my ascending channel. And the kind of candlestick being formed there is a buying pressure candle. It's a candlestick that is trying to indicate a pressure building up or mounting with the intention of traders to push the price up. You forget about this, we just do this. I want us to do it from first principle. Let me first put this away, because I want you to exactly just look at the candlestick itself. Let me first hide my indicator. There. So I hope you're clear. So that is a mini movement that if I were to capture, let me just do this a little. So that seems to be an a mini movement to the upside. But then if I was to capture my support and resistance, this would be a good one. All right. You have this would be the next any point that the candlestick touches on your ascending channel, whether the upper line or the lower line becomes a support or a resistance, depending on the direction of the market. So in this case here, I have two major support zones. And with regards to what is happening on the market, as we can see on the kind of candlestick being formed here, this is a candlestick that is trying to indicate some buying pressure. Buying pressure around where? Around a support zone, around a support zone, because of the line, you see? This is a support zone, right? So if I am to make an entry decision, in this regard, this seems to be the most recent price reaction zone that the price may respect or may rise to here. But if I want to make entry, I'm going to look out for where the possible next resistance zone will be. This seems to be a really entire area. Let me just see. This seems to be an area. Let me see. So there you have this reaction zone where the market price is currently, okay? Where the market price is currently. And on that support zone, we're having a candlestick formation that actually was showing some buying pressure building up on that market because of this formation. Now, what I'm going to wait for is, if at all, after this movement here, I'm going to pay attention to this candlestick formation forming around this support zone. We're having a red candlestick. We are having sort of like a doji, okay? This would be like, I think, a dragonfly doji sort of, but it is an indecision candlestick, but at the same time also a buying pressure candlestick. If you look at it based on the fact that the lower wick is quite very long compared to the higher wick. So I'm going to wait out for this next candlestick which is being formed. If it turns out to be a bullish candlestick, then this candlestick here will be regarded as which candlestick will that be? Which formation will that be? If we have these three candlesticks, the red, the indecision candlestick, and a bullish candlestick, which formation would this be? Which candlestick formation would this be? If we're looking out for the three candlestick pattern formation, which candlestick would that be?
Morning star.
All right. It will be?
Morning star.
Okay. That would be a morning star, right? Do you remember that? Let me just try to go through that and we see. Let's relate together. Because remember, I'm using not that. I'm using the 15 minutes time frame. Paying attention to okay. All right. Where is it? Here. This formation is what we're most likely going to see. Okay. If that candlestick we're seeing forming finally closes up as a bullish candlestick, that is the formation we expect to happen. But remember, it is happening around a support zone. A support zone after what? After the breakout here, after this movement. Let me show you. After this movement here. After this movement. After this great movement. After the movement from this area to that, there was a pullback, which was a retracement, right? It was a pullback. And now we're trying to see a rise. If this candlestick here ends up being a bullish candlestick, this three candlestick pattern formation would be called a morning star, meaning we shall quickly just wait for this bullish candlestick to close and we make entry onto the next candlestick open. And our take profit target would be this area of price reaction here. That will be our target. Okay, that will be our target, because remember we said for a good candlestick formation to be achieved, we need to pay attention to what happens around any support zone, or after a break of a resistance, what happens around that point for us to confirm an entry. But also at the same time, we said a true breakout will always happen in such a manner that if the first candlestick that broke out, which is a bullish candlestick, breaks out and closes above a resistance, and the next one is a bearish candlestick, we don't make entry immediately. We first ascertain what is going to happen there to confirm that breakout. We said we wait for the next candlestick to form. We wait for the next candlestick to form. If it opens and closes above, like we're seeing here on that red candlestick, it opened and closed above. There we can now make entry decision. And the entry decision can be to enter on the next candle, open, that kind of a dragonfly sort of candlestick. It will be sort of like a dragonfly, yes. But then a clear entry decision will be made after a confirmation of the pattern around there. So you just have to wait and hold on and see what happens. But your target will be here, okay? Your target will be there. So in a lower time frame, these are earlier entry opportunities that you can see that may be difficult for you to sight at in a higher time frame like earlier on we had seen. It will be difficult. But if you go to a lower time frame like this, it's easier for you to spot those entry opportunities. It's just a matter of being patient. Now, like if this really happens and it closes the way it is appearing, we have that pattern already formed. So we're going to make entry. Our target will still be this resistance, okay, which is a reaction zone we actually captured from the previous movement here. This one. This is the immediate reaction zone we actually registered in the course of that movement, okay? That will be our target. As simple as that. So you have to pay keen attention to whatever happens around there. Remember, just from what I said, that this support to be successful always arises out of a candlestick formation after the intention of the traders being clear on where they want to push the price. If at this point here, the intention of traders was not to try to cause a buying pressure, like we see here, this was a buying pressure candlestick. It was already an indication of telling you that here the traders are willing to push the price up. Okay. The sellers wanted to move it down, but here, this one here was already an example of what was ready to form. Okay, because the pressure started here and then it was transferred onto the next trading session, which will either continue onto the next trading session if this one closes. You get that? So with that in mind, if you were this person who is impatient, just by formation of a buying pressure candlestick is good enough because it is being formed at that point at a support level because the price has already broken above that resistance. So when the resistance is broken, it turns out to be a support, obviously. Now, because the buying pressure candlestick is being formed around a support already, you've already confirmed your breakout, and now you have a candlestick that is already trying to show you that the traders are willing to push the price up. You just have to wait probably for that to form, and then you make entry on the next candle open. Or you wait for that clear formation by what you're seeing there, man. Now it looks, first of all, this one alone already looks that it's already telling you that the aggressiveness of the buyers at that point was already serious. The pace was already set from this candlestick, this buying pressure candlestick. And remember we said a buying pressure candlestick are all those groups of candlestick that are characterized by this formation. Okay, a long lower wick, right? And either no wicks at the end or a smaller wick at the end. This is a typical of a buying pressure candlestick, which upon sighting at any support zone should give you every reason whatsoever to make entry of a long position or buying if you're on the sports market. As long as it happens around a support, it would be good for you to make entry on the next candle open. If you don't want to wait for those other 3 candlestick pattern formation, it would be good. Okay, just make entry and that will be nice. It can be this, and also it can be like the dragonfly. This is equally a buying pressure candlestick. Okay, and why would that give you confidence? Because you know already this is an established trend that was already on course. You see, it started from here, like we had seen. It had already started from there. So it is already a build-up of continuation of the trend. So immediately a breakout is confirmed. And what is confirming it there is very clear. And then you see the next candlestick being formed after the breakout is any buying pressure candles. It means at that point, the buyers are willing to push the price further up. So you can make entry after confirmation of that buying pressure candlestick. You see, like here, what did we see here? Building up around that support. Let's see. Let's just confirm this together. After this breakout, we had a retracement to this support zone. Now, what played out here? What formation was here to confirm this continuation of the movement? What formation was this? We're seeing three candlestick pattern. What formation happened around that support? Can I kindly see that on the chart? What formation was that? What formation was that? This, what I mean is this one here. It is on our support. After the breakout, it is on our support. It happened on our support. Oh, sorry. This one here, if you can see, it is a red candlestick and then an indecision candlestick. Then thereafter, there was a bullish candlestick. It was a three candlestick pattern formation around our support. After the what? After the breakout. Okay, after the breakout, there was a retest on that support. Now, what would have given us confidence of a reversal to the upside was that candlestick formation, which later on turned out to be a movement that broke this next structure, which was which was a resistance at this point. It was broken at that point. Then we had more of like a similar formation here of a buying pressure building up around that. So which formation is this? Which formation is that? It was a morning star. Absolutely, it was a morning star. That was a morning star. It was a morning star. You see that? It was a morning star. So some of the things are that's how you go about making use of your support and resistance in a combination with those candlestick the candlestick pattern formation. It plays out very well. It plays out nicely. Okay. It's very important for you to note that very well. And now, if there was someone who was patient to wait for that formation, this would be an opportunity for you to now make entry on this candlestick open, because you know what has already formed here is another morning star. So you make entry on the next candle open and still take profit to this resistance. It's that simple. Okay. If you didn't want to make entry on the next on this candle open after the formation of the buying pressure candlestick, you would still wait for this one here, which has formed, to close. After formation of that, then you make entry and target that point, without forgetting that this would be your margin call drop. So from point of entry, you drop it to this. The percentage you get there becomes for your margin call drop for the first call. You get that? So it's that simple. That's why for me, I have said I cannot specify which time frame would be best for you, but according to me, I base on that. That is what I base on. Okay, I base on that to make entry. Okay, I base on that to make entry. Based on that to make entry. So I base on that to make entries. So it's that simple. I don't use I don't go for those big time frames. I use only 15 minutes. Just a minute, guys. I want to check some trade of mine here. Jet set sometimes back. I don't know whether it is already up for. Yeah. This is 53. So 53 point something. That's been 53. Uh-huh. 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 Oh. Two. Okay, so let's Daddy. I hope that is clear for that person who asked. I hope it is clear. Daddy. Is it clear? Somebody saying white soldier. Daddy, are you really sure? Was that a white soldier? Uh-oh. That wasn't a white soldier now. That wasn't a white soldier. Daddy. You really believe that was a white soldier? Let's see. That was not a white soldier. Come on. That was not a white soldier. Huh? It wasn't a white soldier. You know what a white soldier is? So it wasn't a white soldier. It's very clear there. So any question again? Anything else that you want me to clarify? Anything else that you want me to clarify? I think we are good. Then I think we are really good there. If you don't have any question, I think we are good. We understood the candlestick pattern well. What? Sorry for that. That name is Achidri. Okay. Johan is up, please. You can unmute. I hope I pronounced the name right. Achidri.
Yes, good morning, Coach.
Good morning.
Thank you. I just wanted to ask some clarification about the pin bar and the what shooting star. So is the shooting star the opposite of pin bar? That's what I wanted to ask. And also the pin bar also sometimes confuses me with let me say the doji, which is the dragonfly doji. They are kind of similar. So can you kindly clarify and differentiate between the two?
Again, your network somehow cut.
I'm like between the pin bar and the shooting star. I first wanted to know whether the shooting star is the opposite of the pin bar. And then what also disturbs me is the dragonfly doji and the pin bar. They kind of confuse. So I just wanted you to differentiate between the two. Yes.
Okay. Now,
and if you don't mind, there's also something that disturbs me. It's all about the setting stop loss. I don't know whether you use stop loss, and especially when you analyze, sometimes you find that there's some manipulation. You find it immediately after entering, the trade might go against you. So there's that fear you would want to close the trade by, So I don't know whether you use the stop loss. You can also have something about that. Thank you.
All right, you're welcome. Okay, now let me begin from the stop loss. From that point of the stop loss, personally, I've not yet tried out using the stop loss. In fact, I think I don't use a stop loss. I don't use a stop loss because instead of using stop loss, I tend to use the margin call drop. And I'm going to give a reason why. Okay. I'm going to give you some reason here, that explanation. Maybe let me just do this, share screen. Okay. So we, you know, the people who love using stop loss, stop loss is like a forceful closer of the trades. It's not bad, but I'm going to give you my point of view. Okay, I'm going to give. Let me first mute this. So I'm going to give you my point of view with regards to how, you know, on the use of stop loss. I don't personally use it. I tried it once, and the experience has not been good. That is like it's always, I've always not loved using it, because otherwise it would be nice if you're using if you're trading manually. Stop loss would be, you would use a stop loss possibly, but if you have the robot like RoyalQ, using a stop loss would really not be nice. Okay, especially given the fact that you know how the bot has been designed. Okay, you know how the bot has been designed. The bot has been designed is based on the Martingale strategy of dollar cost averaging. The Martingale strategy is a strategy that helps you okay, the general intention in summary is to help you make sure that you maintain the gap or the range between the market price and the average price established in the market on that particular coin, to ensure that you maintain and ensure that the range between the average price and the market price is as close as possible to allow for an earlier exit from the market. I don't know whether you quite understand how the bot works, though, but a stop loss will be depriving you on taking advantage of that strategy. Okay, it will be depriving you of taking advantage of that strategy. Okay, because it's literally something that doesn't make you appreciate the importance of the bot. Remember, whenever the robot buys, it establishes an average price. Let me just use this to explain that. I hope I share my screen. Let's do this. Okay, let me see my screen. Okay, do. So whenever I want to give you an example. There's something I wish you had. Okay, there is something that is what we price delivery algorithm, or the phases within which remember the intention of the market price before the price delivers to a particular direction. Normally, the traders accumulate position. Accumulation of position is literally like you stocking. Okay, you're stocking something. You maybe, I always like giving a simple example of a produce dealer that you want, for example, you have an order of 10 tons of maize, right? 10 tons, okay? You have an order for 10 tons, but then what is available in the market is maybe 8 tons. That is short of the position you wanted, right? It's short of the quantity you wanted. You want an order worth, you're making an order of maize worth 10 tons. But what is available in the market, and why the 10 tons? You literally want to first maybe store, right? You want to keep it in your store. But remember, you're not the only person who wants this maize, right? You're not the only person who wants the maize. But then what is available in the market is possibly maybe 8 tons only. But you have made an order of 10 tons. So what are you going to do? You're going to be holding out, and you're going to hold on. You'll be buying in bits, right? You'll be buying in bits. Whatever becomes available in the market, you buy and add on your 8 tons. You'll first of all buy the 8 tons, right? You buy the 8 tons, you take into your store. You're remaining with 2 tons to fill up the 10 tons. Now, what's going to happen is you'll be buying in bits. Whoever brings it in the market, whoever brings any quantity of the maize in the market, you buy and keep on adding on into your what? Onto your 8 tons. You will continue doing that until you hit that required 10 tons. Then it will be left to you to either sell it back in the market or hold it in a scenario where a demand will be, you're going to cause sort of supply, you're reducing the quantity from the market so that the price can shoot and you later sell. So it will be up to you. Now, what happens is this: in the price delivery algorithm, after this first phase, which we are calling the accumulation phase, in the process of accumulation is where people are accumulating positions. This is mostly used by the whales, the smart money. They accumulate position, and in the process of this stage, normally what happens is the whales will be so careful to such an extent that they don't want to cause any significant effect on the price movement. They want to be moving the price in bits, okay? So that it lures those who are having some of the maize in store to sell. For example, if the price of maize was like, let's say $100, right? And let's say the range here is $100 and maybe 110, just for explanation purpose. Now, what the whales will do, they will be causing, they will be ensuring that they accumulate this position, but without causing any significant effect on the price. So the price will be moving slightly. To somebody who had in stock their maize, if the price moves from 100 maybe to 105, this is a movement that somebody who has their maize in store would want to take advantage of. You say, you know what? I think I'm going to buy. Let me make the difference, the $5 profit. So they're going to sell. Now, whatever they sell in the market, continuing to pick and then adding onto their position. Remember, the goal is 10 tons. Now, if it reaches a point where in the process of the weighting of the accumulation, the price is taking, the quantity is taking, it's taking long, the order is taking long to be filled up, they're going to set a trap. They're going to cause a deception in the market. Now, the deception is where now they're going to be causing what we call fake breakouts, okay? Fake breakouts are intended to take out, one, the stop loss traders, two, the FOMO people, to take up liquidity from those who are in the FOMO category, the people who fear to miss out. Because for them, what is going to happen is there will be an instance where the price will appear as if it wants to break out, right? It will even break out. But then immediately after the breakout candlestick completing, the next candlestick that is going to form will again come back and close below your resistance. And then the next movement is a bearish movement back towards the accumulation zone. Now, in these cases, for someone who does not understand the principle of breakout, or does not really appreciate so much what a breakout would be, what a true breakout and a fake breakout is, There are people who are going to be trapped in this movement. They will be trapped on the wrong side of trade. One, people who trade using stop losses, they know that at a resistance, for example, this level, this is a resistance. They know that once the price approaches a resistance, it is an opportunity to what? To short the market, right? Most layman traders, right? Most traders wouldn't understand this part here, this aspect of price delivery algorithm and manipulation. They will think that when the price reaches a resistance, it's an opportunity to short the market because they know maybe after the price being rejected, the price is obviously going to go where? It's going to go down, right? That is obvious. That's all of us. That's what all of us know. Maybe they have not applied in any aspect of monitoring what the intention of traders would be around that area. For them, they just see it is at a resistance, let me short. So they're going to short the market and probably establish their stop loss somewhere just above the resistance. Now, the whales understand this. The smart money understand this perfectly well. That when they fail to fill up their orders that they require, or it is taking long for the orders to be filled up, they're going to cause deception in the market. They're going to cause a situation where the price will appear as if it is breaking out, but the intention is just to take off these people. Remember, once the price goes and hits your stop loss, the system closes your trade automatically. Meaning, if you had set a stop loss of, for example, 1% from your point of entry, okay, and you had maybe like $1,000 on that trade, that means 1% of the 1,000 would be $10. So you're going to lose $10. But remember, the intention is not the $10. The intention is in the quantity of coins worth that $10. That's what the whales want to fill up. They want that quantity of coin to add up on their position, whose target is 10 tons. You understand? I don't know whether it makes sense, but that is what I'm trying to drive at. It will take off the stop loss traders, meaning the system is going to close your trade automatically. But you'll have less by $10, meaning you're going to have $990, meaning the other 10 has been taken out, right? That's what we call taking off liquidity. So it will close you. Then at the same time, the next category of people who the smart monies are going to take out, or you're going to get liquidity from, would be the people who, upon seeing the market price breaking out, they think that, okay, a breakout has happened. Let me jump in and take a long position because they've seen a candlestick has opened below and has closed above. Without waiting for confirmation, they just want to jump on the next candle open. This candle open will appear as if it is even going up, but before you know it, it comes down and closes below the resistance. Now, for such kind of such group of people who make entry after a breakout or after a fake breakout are going to be taken out because they're going to be trapped on the wrong side of trade. They're planning to go on. They would have entered a long position, okay? But then smart monies would have caused a deception, okay? They would have caused a deception. Am I there? Sorry about that. Somebody called, I think, and affected by network. Sorry about that. So let's come back. So the deception I was talking about is the deception that is going to be caused by the smart money is to take off the category of people who fear to miss out. They want to jump in and enjoy that ride, not knowing that it is a trap that has been set for them. So as they take long position, they are going to simply measure some distance below the resistance. And that is where they're going to take their stop loss as well. As they set their stop loss, the price will deceive them that it is going up. Then before they know it, it comes back down and take them again out. Another stop loss. You get that? Now, for the people who were in the category of getting trapped on the wrong sides of trade, what's wrong with these people? Why are they overcalling my number? Okay. Am I there? Am I being heard? Am I clear? Am I audible? Kindly, am I audible? Let me just make this. Some people are over disturbing me with a call, so they're over disturbing me with a call. So yeah, okay, then let's continue. I just closed that line. I hope they don't call me on the other line again. So let's come back here. So what's going to happen is the two categories of taking people's stop losses is during the manipulation. So the stop loss traders will always be taken out. And then the people who are going to be trapped on the wrong sides of trade, you think that the price is going to go up, and you take a long position. Before you know it, it goes against you. Now, because of fearing for the total liquidation, some people are going to end up closing that trade manually, because now they will be seeing the price is going where? Against them. Yet for them, the intention was they thought the price was going to go up because of looking at a fake breakout and making entry after a fake breakout without even confirming whether it is a true breakout or a fake breakout. So in such cases, the smart money takes out those categories of people. Now, if you're somebody who loves trading with a stop loss, where you are planning to use a stop loss, why don't you use a margin? Why don't you set a margin call drop? That percentage which you are setting, the 1%, you create it, turn it to be a margin call drop for the first call for you, such that even if the price finally goes there, the whales will not take you out, but rather as they plan to take out the stop loss traders, for you, you're not being taken out, but rather the robot is taking advantage. It is again buying. So you are like matching the intention of the smart money. You are trading along with them. You're not being taken advantage of. You are also going along with them. You're playing along with them. Okay? As they're taking out the stop loss traders, they're grabbing liquidity from them, and then finally, move in that direction. That should be your intention also. If your intention is to go short, that where people are actually setting the stop loss, that's where you should also establish your margin call drop for the first call. Because the price is going to come around that place, take out the stop loss traders, but for you, you are in the trade still. As the price now begins going in your favor, you enjoy along with the smart money. Okay? That psychology of trading is what you need to understand. But otherwise, trading the stop loss is like forceful closing of trade. But I don't rule out, if you love trading with it, it's fine. The best you could do is don't set your stop loss around the common areas that most traders love setting their stop loss at. If they love trading somewhere, if they love setting it around 1% above a point of entry, okay, above a resistance, you try to create yours a little bit far. Maybe you go for 1.5% away, or maybe 2% away from the resistance zone where you're planning to make entry at. Set it somewhere far, such that even if the market causes a deception, or the smart money causes a little deception of a breakout, okay, to take out the stop loss traders, it will find for you when you're around somewhere there. You may not be taken out. You get that? You may not be taken out. The price will rise, take out the majority who are around there, and then finally goes there. But for you, you will be somewhere there. So your trade will not be closed. Okay, that will be your stop loss. So it will go into a little bit of a floating loss, yes, but it will finally deliver in your favor. That is what I can say with regards to stop loss traders. Now, finally, the difference between I think what's been a pin bar. Now, a pin bar is a general name. Actually, given to buying pressure candles and selling pressure candles. Remember, selling pressure candles are, we have two categories. There's the buying pressure candlesticks and then selling pressure candlesticks. Let me begin with the buying pressure candlestick. The buying pressure candlesticks are those candlesticks that I just described, that the candlestick that has a characteristic of this nature. They have a very long lower wick. Okay, they may be like this. Okay, with very short upper wick, or they may be like this, or they may be like what? Like this. Okay. The whole idea there is you have a long lower wick and either no upper wick or you have a short upper wick and then a small body. That is the first category. Second category is the doji, the dragonfly, which dragonfly may appear like this. It is also a doji. Remember, dragonfly is also a doji. It may either be like this or it may be like this. But the most significance of what describes it or what gives it the name of the buying pressure candlestick is the fact that they have very long lower wick. Which long lower wick actually describes the intention of the traders in that trading session, their willingness to push the price up. Because after all, when the price opened around there, depending on the candlestick, when it opened somewhere there, whether here or here, depending on the candlestick, remember, you'll have the sellers trying to push the price down. The intention is to push the price down, but the buyers stepped into the market at a later time, picked the price from the low and pushed it up, and either closed it here for the red candle or moved it further and closed it above there for the bullish candlestick. Okay, so the pin bar, a bullish pin bar, would be actually what we call the hammer. Okay, the hammer would be an example of a bullish pin bar. The spinning, the shooting star will be an example of a bearish pin bar, meaning literally it's just a general name that is given to those categories of candlestick. But remember, even if you were to call it in its real sense or its real name, we have this. We have a hammer, which is a bullish candlestick. We have this candlestick here, and the inverted hammer. This should have been called what? A bearish pin bar, right? But we also have a hanging man, which is also like that, but it is a bearish candlestick. You understand? So it's just a general name given to the kind of candlesticks that has absolutely an extraordinary, a longer wick on one side and a shorter wick on the other side, or a longer wick on one side and no wick on the other side, depending on which category you're talking about. If you're talking about the categories with very long lower wick, they will be called the bullish pin bar because they will always be formed around a support zone. A typical example is the other one we just looked at, the one we looked at in this candlestick that we were trying to, in the other coin that we were trying to analyze to identify entry. That was an example of a pin bar, okay? But if you go by its real name, you'll find that they have different names. If it is the green candlestick, it will be called a hammer. If it is a red candlestick, it will be called a hanging man. So it just depends on the scenario or where they are formed, but it's just a general name. There's no difference there, and it has not to confuse you. Okay? It has not to confuse you at all. Okay? I hope it makes sense. If you want to understand that more, you could go to. I have a presentation document that has all those parts described. I don't know if I can get it now, but let me see. It's just a name. It's just a general name given to those candlesticks. I hope I get it here. But okay, let me see. I hope I find it to clarify. Hope I get it here. I'll hope I find it here. Okay, let's see here. I have the names here. So just a minute. Okay, we have these bullish categories. We have this category, as you can see here. For me, normally, why I don't so much pay attention to the names. In my training, I say pay attention to the name will make you miss out. The most important thing is you take more interest in understanding the significance of a kind of candlestick of that nature once it is formed. What is it trying to portray? What does it communicate to you? Other than cramming the name, just know the structure. That this kind of candlestick, once I see it, once I sight it on the card, this is what it signifies. That should be the most important. Okay, but because you may want to understand, you see this here is a hammer. A hammer, which if at all it is formed, where it is formed around a support zone with a little wick on top, that is when it will be referred to as a bullish pin bar. I don't know whether it makes sense. It will be called a bullish pin bar. Okay? When it has a little bit of a wick at the top. Okay, a simple, you should look at this. Because if you try to compare, this is what we call the bullish pin bar. It has a small body. The lower wick is longer and the upper wick is shorter. That's why it is called it is where is it? Here. It is called a bullish pin bar. A bullish pin bar. A bearish pin bar will be the category with a small body, long upper wick, and a very short lower wick. That will be called a bearish pin bar. Okay? But all of them fall under the category of, if it is like that, if it is like this, it will still fall under the category of, a trend reversal a trend reversal candlestick. Okay? It doesn't. That's just the slight difference that for a pin bar, the pin bar, there is always a small body with a short upper wick and a long lower wick. If it is a bullish, if it is a bearish one, this is it. This is how it will be. It is like this. It is still a trend reversal, just like it is with the shooting star. You see the shooting star? The shooting star has no wick on the lower end. It has no wick on the lower end. But if I was to categorize all this, I will call them selling pressure candlestick, like I did here. You see here? Where? Here. That is buying pressure candlestick. Here. They all fall under this category. The selling pressure candlestick. Here. Okay. So I hope that the only thing missing here is that the gravestone doji. It is also supposed to fit here. I just didn't add it. It's also supposed to fit there as one of the selling pressure candlestick. Then under the buying pressure candlestick, we have it. This would be literally called a what? A bullish pin bar. And this will be called a hammer. This are the hanging man, the red candlestick. This is a hanging man. This is the dragonfly. All of it falling under the buying pressure. So the significance there is understanding when you see this kind of candlesticks, when they are formed around a support zone, what is it signifying? It is signifying a potential reversal to the upside. That's the most significance. That's why in my description, I was saying it is formed towards or at the end of a downtrend here. And it is a trend reversal candlestick. It is a candlestick, once it is formed around a support, is an indication of a price movement to the upside. With no doubt. We just saw it in the other candlestick, in the other coin that we're looking at. That buying pressure candlestick. What was that? That was a pin bar, right? Formed around there. But what was the significance? It had a long lower wick and a short upper wick, which was an indication of a buying pressure building up in that trading session, whose effect is going to be transferred on the next trading session. And we saw the effect that the next trading session was completely bullish. It started from that very candlestick that was indicating to us a buying pressure building up in the market, formed around the support. So, ladies and gentlemen, it's just about understanding this, okay? No cramming the name, okay? Just understand these candlesticks, the structure, and then the significance they cause in the market. I hope that answers that question. That answers the question. I know if we were to have a question and answer session, it will be a long one. We'll have a long trading session, a long one. Okay, a long one. But that's just a picture. I hope it helps those who may be having difficulties or were having confusion. But that is just as simple as that. Okay, guys, my time is up. I wish to have continued, but I think my time is up, and I hope it has been helpful to some of you. The session that we just had, what I've shared, it may be little, it may be really simple, it may be easy, but I just hope it is helpful at the end of it all. Otherwise, happy to have you guys, and I'm glad that you guys were here. Much as we got a little bit into interruption here and there, but I believe it was better than yeah, if the question and answer session comes up, yeah, if I have some time, I'll be there, and I will support the person who will be conducting that session, and we just see how to go through those sessions. Yeah, thank you very much, leadership. I see you on the call. Happy to have you as well. Happy to have you there, and all those who endeavor to attend. Please, I'm always humbled to help, humbled to support, humbled to take you guys through any trainings of any nature whenever called upon. So let's keep learning. Let's continue learning, and I hope we shall be good. Okay. All right. All right. Yeah, there's just a lot to learn, honestly. This is just a general picture, but if we were to go or dive deep a little bit on how to transform this information, the chart, what we are trying to look at, we go and now transform it onto the settings of the boat. I think would really be good. We'll be very happy. We'll be glad we learned some of the things, because this information should not only stop at, on the chart. It has to be transformed onto setting the boat and coming out with a strategy that you're going to choose to use while setting your multiple buying ratio. And then you'll be good. You'll always be winning. All right. So thank you. I got a hand here. I think there is a call in a few minutes. You may as well go and attend, so that, yeah, you also learn something from that session. So happy trading, and great weekend ahead for my Muslim friends. Juma Mubarak, blessed Friday prayer. Okay. Bye. You can exit at will. You can exit at will. I always give some moments for people to exit at will before I end the session. Yeah, we normally cannot exhaust this all in this kind of sessions. Yeah, we cannot exhaust everything there, really. The time is always limited. Yeah, we have a limited time, and here we're basically giving insights. Okay, yes, they help us appreciate what we're doing. So let's meet there in the next call, possibly. Bye-bye.